Good morning. Welcome to the XM.com weekly market update. And with me again is Peter McGuire, the CEO of XM. Good morning, Pete, and welcome back.
Lovely to be here, Andrew. It's good to see you.
A couple of weeks in the Middle East and India.
Yes, it was. It was very, very busy. And I'll tell you what, the infrastructure spend in India is just immense, and so is Dubai and Abu Dhabi. So, construction, underground railways, tunnels, bridges, you name it, India's doing it. And collectively, I believe that they're building larger railroad than Germany each year.
Wow.
The size of the German railroad system.
Yeah, well, we might sort of touch on India next week because
Absolutely.
There's plenty of commentary around India at the moment as well, how the market is opening up a bit. So we'll save that for next week.
Well, I don't think it's their decade. I think it's their century.
Could be. Now, just starting here domestically, not a huge amount happening on the Aussie market. The RBA minutes came out this week. Not a lot out of that. They indicated that they thought about putting interest rates up, which seems very surprising. But looking at the Aussie dollar, hanging around that 65-cent mark, it's sort of languishing a bit. And once again, a lot of that is related to the weakness coming out of China.
Yep, exactly right. And imagine if they did run rates up. The critical shortage as far as housing in Australia is massive. People living in cars, and you just can't, there's no, and your net migration. So I don't know how, if we have energy prices and our inflation rate was to tick higher, then they probably will raise them this year. And everyone else is thinking of cutting, but tell you what, I think we're a long way from over.
Yeah. We'll head over to the UK. Plenty of activity over there at the moment. The CPI came out still around that 4% mark, which is still pretty sticky, and they just can't get it down.
No, they can't. And just for everyone, there's a little lesson. That 4% certainly, and you look at that number, that's 4% plus the year before. So you're running at close to 16% inflation from going back about 14 months ago. And that's where the cost of goods are just out of control. And the herd on Main Street in London and across UK is the fabric of the society has broken down. And we're feeling it. That's where, and this is where this next chart takes you, Q on Q, domestic product, and when you're looking at that GDP. We spoke off air, Andrew, when you said around about the best part of 16 months ago, if you go back to October of 22, and that's been bleak since then. So we haven't seen any growth for a long protracted period of downtime, and I worry where we go moving forward with a 0.25, about 0.27 or 0.3 for that February number, GDP. The next quarter could be or the next month could be very, very tight.
Yeah, in these established economies as well, you don't get recessions a lot.
No.
They're few and far between, but that chart, so the UK's had 2 recessions in 2 years. So you've got with 2 negative quarters in 23. And then now in this month.
Well, they might have fudged the numbers. They may have been in recession for the best part of a year and a half.
So, and looking at the pound as well, similar sort of situation to Aussie dollar. Not a lot of strength there at the moment.
No, it's certainly not. And that seems to be it's range bound. It's very. There's no real breakouts against that US dollar. Certainly against the yen, it's been strong, Andrew, and it's not bad against the euro. But against the US dollar, it's been very, very much in a channel, and that would offer, if you were being an option trading strategist, condors and strangles and straddles, all of those sort of technical tools that the traders use to, trade in a tight band.
Yeah. Over to the US, obviously we're getting to the tail end of earnings season, which has been a bit of a mixed bag. The big companies once again have performed pretty well.
Very well.
Which is not.
There's only 6 of them. That's the trouble out of 500.
So, well, that's right. So, and obviously, Nvidia came out yesterday with some sort of unbelievable numbers.
Well, the Nasdaq was up nearly 3%.
Yeah, and even,
smashed.
And overnight as well, it's picked up quite a bit. But we're getting sort of really mixed signals out of the US at the moment. You've got retail sales down here, which obviously measures what's happening, as you say, on Main Street. Yet we've still got very low unemployment numbers. GDP is relatively strong.
Well, they're second jobs and they're part-time earnings. That's the reality of the matter. And I thought I'd just give you a quick heads up. When we're looking at actual data as far as Hedge Count, Twitch, 35% of its workforce eliminated. Hasbro, 20%. Spotify, 17%. Levi's, 15% of their workforce. This is all how much. Qualtrics, 14%. Xerox, Xerox 15%, Wayfair 13%, Washington Post 10%, eBay 9%, PayPal 7%, Charles Schwab 6%, Citigroup 20,000 employees, BlackRock 3% of workforce. That's just, Andrew, this is catastrophic to the workforce.
But it's sort of interesting how it's not getting reflected in those unemployment numbers yet.
No, they're second jobs or part-time earnings. You know, you get a job for 8 hours a week and you say you've got a job, you've gone from 40 to 8. But I take it, and this is all going to be reflected in retail sales. Dollar, the wallet and the purse. How much have you got? Because credit card debt's back at 2007, 2008 levels as far as debt, and they're tapped out as far as credit card. 24 is going to be an interesting year. I called it too early on 23, but I'm not going to say what I think it's going to happen by the end of the year, but I think it's going to be a very, very wild lead up to the election.
Yeah, for sure. And once again, similar situation in the US with inflation. It's come down obviously quite a bit, hovering just over 3% now. Yeah. So, which is better than some other economies around the world, but they just can't. Once again, it's a bit sticky there. So, which basically means any interest rate reductions are on hold for the foreseeable future.
Well, they're saying now June. It was supposed to be March. We had full steam ahead, fear of missing out rally in October, November, December. You and I were saying, right, it's going in March. You've got another cut in possibly April or May. Now there's no way it's happening in March. There's no way in May, and there might be a chance of as far as June's concerned. And some people are even saying it's going to be the tail end of summer, July and August. If crude energy prices were to creep up from here, then that's going to be a handbrake as far as inflation coming down. And you've got the turmoil in the Red Sea, and you've got a drought, people aren't realising it, in the Panama Canal, which is causing major concern as far as shipping and the cost of goods travelling around both the bottom of South America and the bottom of Africa.
Mm-hmm. Plenty of activity. Dollar index?
Yeah, just under 104. Can't do a lot. We had it run at 105 and everyone was trading it long from that early start of the year or around Christmas. And then it's back and it's given up a bit of that hot steam, but it was a fantastic trade to be long currencies over the first 6 to 7 weeks of the year.
It certainly was. And just finally, have a look at these 2s and 10s, which we'll touch on every now and then.
Well, there, my friend, is your story. Go for it.
So, the bond market pretty much controls everything. So, we saw it come off quite a bit late last year, which was fair considering the commentary that was around at the time.
Yep.
But creeping back up now that the Fed's backed off with the interest rate talk, or the talk of a cut, that is.
Yep.
And they're creeping back up, not to that high levels we had around that September mark, correct, yet. But the markets slowly, they're changing their tune. And like we sort of said, the debt market or the bond market, it pretty much drives everything else. So
absolutely. Higher costs are going to impact naturally the consumer, credit card debt and household mortgage. And the second part of it is, if there's no chance of any rate cut pushing out now, we're only in February. If you go out to another 4 or 5 months, I won't be surprised to see your 10-year possibly close to that 5 handle. And certainly the 2-year might even hit 5.5. So yeah, it's strap yourself in.
Yeah, plenty of
it's reliant on those rate cuts.
Well, it is. Or the market is. And once again, I think a lot of it, you could nearly say any rate cut, so whether or not they have 2 rate cuts this year or 3 or whatever, all of that's nearly priced in anyway to the equity market.
That's right.
So not to the bond market, of course, because they could come down. But so you would sort of think at some stage, and because the equity market's been so hot, even year to date,
even last night,
you would even think at some stage you would probably see it come off a bit, probably not substantially, but come off a bit and probably range trade for quite a period of time.
Yes,
and that's how maybe the second half of the year may play out. So.
I want to see China. We're going to pull apart a couple of numbers over the next few weeks. You said India. We're going to do a special on China. We've got to take on board where they were as far as equity markets, what they're doing from a stimulus perspective moving forward from a central bank initiative, and then possibly we'll roll across the other parts of Asia together and then look at a euro. So yeah, hopefully we can bring a little bit of knowledge to all our viewers, because it's a global platform, and there's a bit to discuss over the next... You've got 70 countries this year having elections. I mean, that's just sweeping.
It is.
See you next week.
Yep, excellent. Thanks for joining us again, Pete.
Thank you, Andrew.
And that's the XM.com weekly market update.